All right. Sound check.
Yeah, hello. Everything's fine.
Good evening.
All right. Just want to make sure I'm not on mute. Welcome back, everybody. Meeting four. Let me talk about the agenda for today. A little bit about the logistics, what's coming up. I'll talk about the next set of assignments. I will talk a little bit about the projects you already submitted, the first part and the case one. So the grades have been posted. So you should have your files back. Some with more comments, some with less. So generally, very good job on project one, first part. We will do the case. We'll do the Midland case. All of the groups should have submitted by now. And that will take the bulk of the first part of the meeting today. And then we'll move into the next topic that will be the company valuation. So what we'll do, we'll take the template which was developed for the project analysis in the first case, the ocean carriers, we'll extend it and apply it to a company valuation rather than just a project valuation. But you will see it's very similar with some adjustments. So that's what's coming up, and that's where the next the next set of assignments are coming in. And remember the project, your individual company analysis, that was just the first installment. The rest, the bulk of your individual work will be analyzing the company value. So what we cover today on the case, the cost of capital for Midland, and then the company valuation will be taken. So all of those templates you would need to take and apply to your company analysis. So after today's lecture, you can start working on that individual assignment. It will be due in week 8. Okay, so there is some time. Obviously, you have to complete. But the earlier you start, the more chance you have to work on that data. Again, you can do as much work as you would like to on company analysis on your individual project, or at the minimum, you still can get a good grade. I'm not asking you to do anything beyond what will be in the assignment. But this is why I pick individual companies, so you can go as deep as you would like to. Okay, so that's the whole point of picking up your own company. Okay, there will be a minimum requirements set. I'm still editing it a little bit, so I'll post it likely next week. But again, this is your chance to build your own portfolio if you would like to, interview for a different job. This is something that you can present your own work, own valuation analysis. Okay, so that's something for you to consider. There will be 2 quizzes, as stated originally. They each are worth about 5% of the grade, so 10% for the quizzes. I'm working with the admin, your program admin. They need to allow me to do the timed assignment. This is not set up correctly on Moodle. So the way it works, hopefully that will be resolved, within a day or 2. I'll post a quiz. The next will be due before class next week, next Thursday. It will be timed. So it's a technical assignment. You go in, there will be 3 questions that you need to calculate the weighted average cost of capital, some components of the cost of capital. It's a kind of a mathematical exercise, but I would like to set a time limit, something like 90 minutes. So you go in, you start working on it, and in 90 minutes you need to submit. Okay, so that's the 2 assignments that will be timed in this course. Okay, as long as the admin gives me those features. So that's what I would like to do. If not, I'll figure out how this is going to work. Okay, so I will post a separate announcement for the first quiz. So the first quiz will be due in week 5 next week, and the second quiz will be due in week 7, the last meeting that we have. Okay. So again, those will be technical calculations, again, based on our discussion today for the first quiz. So that's pretty much it on the logistics. All right. You do have another case, another group case. That will be the company valuation. And that will be based on our discussion in the second part of the meeting today. Again, taking the template, expanding it to a company valuation, and application will come in the next group case that will be a company valuation case. All right. So that's what's coming up. Anything you need to, you would like to clarify? So let me open up my chat. All right. Okay, so I'll keep my chat open. If you do have questions, again, either raise your hand or type it into the chat section. Let me go back a little bit towards the.
I have
Go
a
ahead.
question. There was a case with individual project part one, when if you submit your work before the deadline, there is no option to unsubmit it.
Okay.
Like if I understand that something is wrong there, I can unsubmit and then submit it again with correct version. Is it will be fixed in part two, or this is just like a policy? Because in other courses we have this option before the deadline, I mean.
Let me look into this. Just the disclaimer. I'm not normally teaching on this platform. I'm using something called the Canvas, so that's more familiar for me. Moodle. I'm less familiar. I used to teach, many years ago in Moodle. That has changed quite a bit since about 20 years ago. So ideally, you should have one submission. Okay. But if I need to enable to resubmit, let me look into that.
Okay, thank you.
All right. Let me actually talk about the first part, the first submission that you did. Again, the purpose of the first part was for you to get to know your company, basic ideas, who runs the company, the CEO, the board of directors. That's relevant to the first discussion we had in this course about the corporate governance. Okay, how the corporation is structured. Obviously, we talk about publicly traded companies in all of those cases. So you have a lot of financial data that the companies disclose, and that's the whole purpose of is to take that data, analyze it, and eventually produce a valuation. Okay. First part was more qualitative than quantitative. There was a section D, and one comment. If your assignment says section D, answer all questions, well, you answer all questions. You do not skip. All right. So make sure to follow the assignment as it states. Like the first part says, you don't have to tell me the exact compensation of the CEO. It will come in handy in the second part, because I will ask you one qualitative question on the second part about the CEO compensation, about the workers' compensation. That there will be a discussion part, and I will ask you to provide your opinion. All right. So again, one comment on AI, artificial intelligence. As I said, there is no restrictions on using AI in this class, but you need to acknowledge it. All right. And some of you did. So I used this particular engine to get some answers. Okay, that's fine. All right. Obviously, if I ask you to provide your opinion, that's not an opinion of AI. All right. So make sure to follow the instructions. I will be looking towards your opinion in the second part on some of the topics on corporate governance. All right. So you can obviously consult AI but if I ask you for your opinion, you provide your opinion. Okay. Most of the work in the second part will be technical, calculating the cost of capital, calculating free cash flows, putting it up together, calculating enterprise value and value of the company. So that's the bulk of the work in the second part of the individual assignment for the company you selected. So AI is fine. Again, acknowledge it if you use it. There will a comment that will be relevant going forward, so, especially when we do the valuation. Remember, in Part D, I asked you to calculate the ROE and ROA, return on equity, return on assets. For that particular exercise, we did, and I pointed it out in the assignment, you did the accounting ratios. So accounting ratios use the book values, all right? And already last week, if you remember, somebody else, so when do I use book? When do I use market? And that started to, hopefully, by the next couple of meetings, it will become clear where the book value belongs, where the market value belongs. Generally, in finance, we try to use market value as much as possible. All right. And I will point out those instances where book value is okay. All right. But like ROE, and I think somebody mentioned last week, and in some of the submissions I've seen negative ROE because what? The balance of equity on the books is negative, and it could be on the books. Remember, I said the equity value cannot be negative. I had in mind the market value. Okay, the market value can go down to zero. It cannot go negative because it would mean literally the shareholders owe money to the company. Okay, that doesn't happen. The whole principle of corporation is limited liability. So you can lose your investment, but you cannot go negative. With the book value, it's possible that the company paid more in dividends than they historically collected from shareholders. So accounting might show a negative equity. Obviously, ROE or ROA, and that's ROA is kind of more stable. You do have assets, but ROE might show a negative number. Obviously, that's a meaningless number, right? Wouldn't have any interpretation. Okay, so yes, technically, the book if you use the book value of equity, you might come up with negative ROE. That's what comes out of the calculation, but there is no economic interpretation of that. That's why we switch to, in most cases, to the market value. And I'll show you when we do the case today how this is applied in practice to measure the performance of the company and to measure the performance of the managers. Okay, so that's where the corporate policy part of this course comes in. How do you actually apply it in real life? Okay, so that's where the market values come in, and that's where the preference in finance is for market values. Okay. So don't get confused. It might look, one part is negative, one part is positive. Which one do I use? As we go through some exercises, it should become clear as we go through the calculations. All right. So that's on the on individual companies, your individual project. The first case, and again, most of you did a good job on an individual project. Again, if it says complete Part D, all questions, complete all questions, so do not skip. So that's should be obvious by now. The group project, the ocean carriers, something to point out, and I think this is important, that's where the confusion might kind of creep in. I'll ask you a question, all right? And so let me see, where is my chat? All right. It doesn't let me reset the chat. Let me see. Well, I'll keep it open for everybody. I wanted to restrict to individual answers. Let's see how this works. Here's the question. You go through a project analysis and you calculate an NPV. You have two projects. You need to select one. The project one, NPV is $1 million, a positive number. Project two, the NPV is $1, not a million, not 1,000, but $1. Which project is better? Obviously, there is a trick there. What do you need to know to tell me which project is better? Again, for project one is 1 million NPV after all of the free cash flow calculations, after all of the discounting, you calculate NPV at 1 million. Project two, you do the same thing, you come up with $1. Johan.
I suppose project one is better because NPV is higher than project NPV one. Will this add more value?
You're falling for a trick, but Timur?
Yeah, I guess like net present value shows possible value of this project. So we need to know something like our budget and like riskiness and other stuff to decide besides net present value. So it's hard to decide using only this data point.
So what piece of information do you need to make a decision?
Return
I
on
can't remember
investment.
this metric, but
Okay.
I'll try to find it.
We'll get to it. Marco?
To compare not NPVs but IRRs, and that's where we need our amount of initial investment and timing probably. So, but timing we already take it into account while we calculated NPVs. So, initial
All
investment.
right. You mentioned one important detail, which is critical. I'll come back to this.
Yes, general like big NPV, it's okay, but maybe this case is not available for us because we don't have such amount of capital for this investment.
All right. So that's what Marco referred to. You need to know the investment amount. All right. And here's the realistic scenario. I do this analysis, the NPV analysis for new projects, and marketing department. A person shows up, says we have a wonderful project, and it will generate $1 million NPV. So what's my question? How big of an investment are you talking about? All right? Because think about this. If project one requires a $10 million investment and you generate $1 million NPV, obviously your IRR will be pretty high. Okay? That's a good project for me. Well, it depends on the size of my business. What's if the project two requires $1 billion investment? Because that's the size of my business. We're talking about billions of dollars in revenue. All right? And eventually you produce $1 NPV. What does it mean, $1 NPV? Because that's a reaction to some of your comments saying Ocean Carriers, it's such a small NPV, barely positive. But what does it mean? Remember what was the discount rate in Ocean Carriers? I think 9%. So what does it mean if you have a $1 NPV? You are earning 9% on your investment. And it's a positive NPV. Even $1, it's a positive NPV that means that the company generates 9% return on that investment. So if I invest $1 billion and I have a positive NPV, I generate 9% on my investment of $1 billion. That's $90 million in what? In return. And that's the minimum required. And that's what the company generates. That means the company meets the hurdle. Remember, the whole point is to meet the hurdle, is to generate enough profit to satisfy the minimum return requirements. So this is a very common mistake. Even, sometimes you talk to senior managements and they look at the list of projects and say, oh, this is a much bigger NPV. Let's go for this project. But think about this. How many projects do I need of 10 million each to match the investment of $1 billion? I would need 100 projects to match the investment of $1 billion. I might not have the management resources to manage 100 projects, 10 million each. Do you follow this? All right. So make sure this is clear in your mind that, and again, there was some comment saying, oh, there is a risk. There is still a lot of risk in this project, and it's barely a positive NPV. Not a good project. Well, how do you manage risk in your analysis? You have denominator and a numerator. You have the cash flow, you have a discount rate. So if you consider the risk, you adjust either the cash flows, you say the cash flows might not be as high as I expect, or more likely, you will manage your risk through the denominator through what? Through a discount rate. That's the whole thing of capital asset pricing model, is to measure the risk. Remember the beta and the cost of debt that is embedded in the discount rate? That's where the risk is managed. So if you think this is a risky project, increase the discount rate and see what comes out. If it's still a positive NPV, you already accounted for the risk. That's the whole purpose of the NPV model, is to incorporate, as long as you can measure this in dollars or a discount rate, you can express your view on the risk. Okay? Do not say, I calculated my NPV, but there is a risk. Well, embed it, put it into your model. Make sense? Mitro?
Yeah, it puzzles me a little bit. If we have these two different projects, one of NPV 1 million and one of NPV $1, and because of different investments and different returns, how can we compare them? What numbers should we compare?
Okay, I kind of alluded this. So we are the small business lending at Wells Fargo. We are a multi-billion-dollar business. Okay, so our net income is in hundreds of millions of dollars. So if a marketing department comes up with a new product and it requires a $10 million investment, and it might be a wonderful product, but does it move the needle for me as a division? On the margin, yes, it will be, a little enhancement, a little small product, but for the total corporation, a $10 million investment would I would need to allocate management resources to that particular project. So it would be just too small. For a small company, that might be a wonderful project. But for a large company, an investment of 10 million might do very little to change the total picture. So that depends on the scale, on the amount you invest. Does it make sense?
Is there any numbers that could suggest us a scale?
Oh, okay, so think about this. Let's say I generate $1 billion in revenue per year. Okay, this additional project will increase it by 5 million. What's the percentage increase in revenue? Very, very small.
Yeah, quite marginal. I mean, to compare between different projects, between different NPVs, can we use some value, I don't know, to
No, you
match their sizes?
it has to be scaled by the size of your business. So if your revenue increases by 0.5%, you're wasting your time. Okay? So I cannot tell you, okay, this is the number, this is the good number. This is the number, that's a bad number. This depends on a scenario, on the circumstances. Okay? If you have a big business, that 10 million would not make any difference for you. Okay? For a small company, 10 million might be a very significant amount. So again, this is kind of common misperception about the NPVs. Okay, you cannot just take NPV regardless of the investment amount. You have to look into the size of your investment and then decide, okay, which NPV, which project, which combination of projects would be a better decision for a company. So there is no one number that says this is good, this is bad. It depends on the scenario, depends on the size of the business and so on. But as long as you correctly or as best as you can calculated the free cash flows, the discount rate, and you calculated the NPV is positive, the project is acceptable. Even if it's just $1, you generate sufficient return to meet the hurdle, to meet the discount rate. Okay, so that's where they very often you see this misconception of saying, "Oh, this is a small NPV." This is driven by the size of the investment. So any positive NPV is acceptable. Then you decide between the projects. But again, they have to be about the same scale. They cannot be vastly different. Nikita?
Actually, may I get back to individual assignment? I'm really interested in what is the difference between book value of equity and the market value of equity?
All right. So the example I gave you in the cost of capital was a company called Chevron. Okay. It's an oil company. It was established more than 100 years ago. So what does it mean, book value of equity? So the shares that the company issued 100 years ago was sold for some amount. That book value sits on the balance sheet of Chevron today. How relevant is a share price 100 years ago? Not very. So that's the book value. Again, more recent companies like high-tech companies, the equity value will be more relevant because it's more recent, okay? But not necessarily because they might be repurchasing shares and eventually end up with a negative number. So again, kind of general sense, younger companies, the book value is more relevant, but still it's a historical value. So that's the book value. The market value is today's value. That's what investors think. What's the value of the company today? The share price today multiplied by the number of shares that the company issued. So that's why in finance, we mostly rely on the market value rather than the book value.
Okay, thank you very much.
Okay. All right. So again, this is a very common confusion. So if you end up, still a little vague, we'll do multiple exercises trying to go through this in more examples. Something that I would like to spend a little time. So let me see if
actually there is additional question in the chat about return on equity.
Okay.
So maybe you can reply.
So again, I mentioned that equity could be negative on the book value, so that calculation is meaningless. But even if it's positive, yes, ROE can be negative. Return on equity, if the company lost money in a particular year, so think about 2020, the pandemic year. You will see, if you do the historical, let's say you take your company and go back in more years than I said, 4 or 5 years, Go back 10 years and see the ROE. Many companies showed negative ROE in 2020 because of the pandemic, because of the big losses. You keep your staff, you pay them, and your sales disappear. Think about some hotels. Very few people stay in a hotel, in 2020. So you will have negative income and negative ROE. That's fine. That's perfectly fine. All right. But if you see negative ROE for many years, remember I showed you GM, General Motors, last week, the article that the GM exited European markets. They sold their business to Peugeot. They had negative ROE for many years from the European operations, and that was the sign for company to exit this market. They couldn't make it profitable. They couldn't meet the cost of capital requirements. So that negative ROE, that's what drove the decision. All right. Now, something that I posted the solutions. I didn't go through this in class, so I would like to spend a little time on this because I will ask you to do this in your individual project. So let me do this. This is the week 2. I showed you this example. Remember, we did the project analysis. I gave you the income statement, and then we picked the operating income, and that was the starting point to calculate free cash flows. So we apply the tax rate, we add back depreciation, calculate a change in net working capital, adjust it for capital expenditure, and other adjustment. In that case, that was a salvage value. So that's a project analysis. Now, obviously, you make certain assumptions for your analysis, and in this particular case, there is one variable, cost of goods sold, was estimated at 60% of sales. Very, very common approach here. We'll see this going forward. When you measure the components of your income statement as percent of sales. So that's a fairly common. Also, it could be working capital as percent of sales. Also a very common approach. Depreciation. The capital expenditures also could be measured as percent of sales. So in this particular example, only cost of goods sold as a percent of sales is expressed. But where does that number come from? Well, if you do this within finance department, you consult some SME, subject matter experts, and they will tell you for this kind of projects, we expect cost of goods sold to be 60%. Is it going to be exactly 60? Well, so here's my NPV. So let me make it 1 decimal. So 8.6 million. Obviously, depending how you change this, if your cost of goods sold comes in at 61%, that becomes more expensive for the company to operate this project. Your NPV will go down. So this will go down to this. If you go to 62%, your NPV will go down even more. So it will be like this. So a couple of questions there. You might say, okay, what's the maximum cost of goods sold I can run this business and still have this project acceptable? So a couple of ways to do this. The easiest one is to use the Excel function and say, okay, what's the minimum NPV you can the project to be acceptable? And that would be 0. All right. So you can run something like this and say, all right, here's the data. I go to what if analysis and say goal seek. And I say, all right, this cell NPV, which is C41, if I set it to 0 by changing my cost of goods sold, all right, and I'll click OK, it will give me an exact percentage that will drive my NPV to exactly 0. So I can absorb up to 68.2% of cost of goods sold and the project still be acceptable. It's called the break-even point. Everybody follow this? All right. Now, so this is the break-even. Let me return to 60, and I'll do something here. So let me do this at the bottom. So I'll do this sensitivity analysis. All right. And I'll say, okay, what's the reasonable range for cost of goods sold? And in this example, I run it from 56 to 68%. So let me put it up here. 56%, and I'll do it in the increments of 2. All right. So I say the cost of goods sold based on the conversations with subject matter experts can be in this range. So how does the NPV changes? How sensitive is NPV to the changes in this particular variable? So what you do, you say, okay, my NPV is this number. So you put a reference to the formula. All right. And you say, okay, I will run my sensitivity analysis. I go to data, I go to what if analysis, and instead of goal seek, I'll use the data table. All right. And since my data is in the column, so I'll put this variable, and I'm testing the cost of goods sold. I'm testing this particular number. All right. And I'll click OK, and it will give me these numbers. All right. So what happens, so this is the basic assumption at 60%. This is 8.6 million NPV. But you see, Excel gives you NPV for each of these assumptions. So it gives you the sensitivity, meaning you change one variable and it changes the output of your model, your NPV. Okay. And what I did here, I graph it. So that's a pretty typical part of the business plan. And I do sensitivity to cost of goods sold. And I do sensitivity, I'm not showing here, I do sensitivity to a discount rate. All right, there's two variables. And that's something which is a very common in business and financial analysis, okay? Because you're looking into the future is uncertain. To take the variable, run the variations of that variable within a reasonable range, and see how the NPV changes, because it will show you that at some values of your input, your NPV might go negative, and the project becomes what? Unacceptable. So for the decision maker, most of the decision maker would like to have one number, one NPV, but that's a better presentation of your work when you say, okay, here's the point estimate, but around that point, there is some sensitivity to this variable. Here's the output. Here's the outcome. Okay. So again, changing one variable at a time, looking at the result, and see what comes up, and how often you see a negative NPV. If you want to be a sophisticated analysis, you can do. Anybody that's done any Monte Carlo simulations? Some of you, okay, might have heard about this. So that's kind of the next step. And some software allows you to do the multiple changes. So let me kind of extend this. Now, sensitivity analysis, you do changes to one variable at a time. What if you have multiple variables? Well, if you change more than one variable, then it's not clear which variable impacts the output, the NPV, more or less. All right. So in that particular case, you do something called the scenario analysis. Again, very common part of a business plan. And scenario analysis works like this. Typical a presentation will be 3 scenarios. Expected, we call it the base case. All right. And those are the variables that you see: the discount rate, 9%, the cost of goods sold, 60% on the base case, and capital expenditure is 24 million. Now, you test it for the worst case. You say, okay, my discount rate will be a lot higher. My cost of goods sold will be higher. And my capital expenditure, I cannot do it in 24 million. I need 28 million. So everything goes against you. And you see what NPV will come out. All right? That's the worst case. So in this particular case, the decision maker can look at it and says, well, under this scenario, my NPV is negative. The project becomes unacceptable. And the other direction, the best case, you say, my discount rate, I can borrow money at a lower rate. My cost of goods sold, I can squeeze out some cost from my suppliers, and I can build this project with 20 million, not 24 million. So your NPV becomes much higher. So a very, very common approach to submit a 3 scenario: the base, the worst, and the best. Okay, and if you have the software, you can run 10,000 simulations with different variables plugging in and building a distribution. It will be a normal, typically distribution, and you see where most of the NPV will land. And if you see most of them landing in a positive NPV, so this gives you a lot more comfort about your inputs and about your model. Okay, this is, some corporate finance departments do use this. All right. So in some bigger companies, some more sophisticated analysis, they do use Monte Carlo. All right. I'm not going to get there. I don't have the software to give you, but just keep in mind that that option exists. So for your individual company, I will ask you to do this scenario and this sensitivity analysis to some of the variables at least. Okay. So as we do this company evaluation next week, I'll demonstrate one more time this sensitivity analysis in Excel. All right. So that's the kind of the wrap up on the project analysis on project on the group case 1. So those additional tools I'll demonstrate again next week. So something that I will ask you to use for your individual project. All right. So any questions? Let's move to the case. Let me see. Well, I didn't get the functionality, so I cannot restrict to individuals, groups.
We can choose like a direct message to you and send it directly to you in the chat.
All right. So I will ask you for 4 numbers. The corporate weighted average cost of capital, and then for 3 divisions. So again, following this suggestion, pick a direct message and send it to me for those 4 numbers. So state corporate WACC, division 1, 2, 3, what your calculations are, and then we'll start the case discussion. Do include your group number so I know where it comes from. And there was a comment about negative income, a negative book value will make a positive number. Well, mathematically, that's correct. But in your, if you ask to calculate it, put NM, not meaningful. All right. All right, let me collect this. All right. 1, 2, 3, 4, 5, 6, 7. All right. So you should know by now how this works. A spokesperson for the group should be ready to step in and talk. We'll start with the introduction, and then we'll address questions as posted for the assignment. All right, there is some corrections here. Okay. So an introduction. What's the case is all about? What are the issues there? Before we get into the actual questions for the case, any group would like to volunteer and do and kind of set up the case for us?
I can actually group one.
All right, go ahead.
So Midland is a very big energy company. It has several divisions, like 3 divisions: exploration and production, refining and marketing, and petrochemicals. Their vice president, on annually see the weighted average cost of capital for corporations and divisions, and these metrics are using for M&A decisions, shares buyout, and so on. In terms of strategy, they want to actively develop foreign projects, invest in this project with positive NPV, optimize capital structure, and that's it.
All right.
Yeah.
So let's get into some kind of specific details. So question 1, what are the applications of the weighted average cost of capital calculations within a corporation? So we'll go through. So that's the regular process. Corporations go through this exercise on a regular basis to estimate the cost of capital. How do they use it? Okay. So the next group to volunteer. All right, Natalia, what group are you?
Yes, I'm from Group 2. Specifically, the vice president and the company overall, they calculate this cost of capital for different purposes. First of all, it can be a discount rate included in the discount rates for discounted cash flow analysis in the company when they choose some specific investment projects, for example. Also, they calculate this capital cost of capital for hurdle rates. The same for investment purposes. It can be benchmarks. It can be also a merge and acquisitions proposal. Yes, if they also need to estimate some costs and some benefits from it. Also, it was mentioned in the case that they plan to do this stock repurchase decision. This also may be used, yes, for these purposes. And to be more clear, yes, vice president uses WACC as the cost of capital for the calculations in most for cases, and this WACC is used for these purposes that I have mentioned before.
Okay, so let me step back and kind of review, maybe add something there. So first one, you mentioned the investment decisions. Okay, generally in corporate finance, we call it capital budgeting. That's kind of the topic that we discussed. So example, we already did last week. Remember, you have a company buying, not buying a new ship. That's the capital budgeting decision, because why we call it capital, it's a big capital purchase. The amount will be spent and the asset purchase will be put on the balance sheet and then benefit the company for many years. That's why we call it, you capitalize this investment. That's why we call it capital budgeting. All right. And obviously, last week, when we discussed the ocean carriers, the discount rate was given 9%, but it didn't come from nowhere. You had the finance department doing the analysis and coming up with the appropriate discount rate for this particular company, and it reflects what? It reflects the expected risk of the cash flows. All right. So this is the industry specific and company specific measure. Depending on the perceived risk, you measure the data, you measure the cost of debt that you need to borrow, you put it all together based on the capital structure of the company, debt and equity, you put it together, you calculate a discount rate, and then when finance department does the NPV calculations, that's where the application comes in. All right. So that's the investment projects. That's a big part of corporate finance. M&A, buying other companies. This is a little trickier because if you're buying a company in the same industry and the same risk of the cash flows, the same discount rate might work. What if you're buying a company in a different industry? Do you apply the same discount rate?
We think that if you buy in different industry, you should calculate discount rate specific to that industry.
That's right. So the discount rate should reflect the expected risk of the cash flows. And if the company you buy in a different industry, that risk is different, you need to recalculate it. You cannot apply your own corporate discount rate. Okay? So make sure this is clear. So this is on the M&A. All right? Stock repurchases. We'll be talking a little bit about the corporate decision-making on dividend and distribution of cash to shareholders. All right. One of the ways for the company to compensate shareholders is to repurchase shares. It kind of sounds counterintuitive, but that's the way it works. So think about this. Remember the PE ratio that you calculated for individual projects? So if you repurchase the shares, your own company shares, what will happen to the PE ratio?
It will
'Cause remember-
decline
Well, think
because
about it.
there will be more equity. No.
Hold on, hold on, hold
It
on.
will. Yeah. So it will decline because the price. Well, price might fluctuate, but there will be more equity because they repurchase their own shares.
Okay, so think about this. If you repurchase shares, what happens with the number of shares outstanding?
It decline.
It will shrink.
Mhm.
What will happen to the earnings per share?
They
Will
will
increase.
It will increase because you divide by the smaller number of shares.
But it
Right.
depends if the company liquidate shares or they hold they on balance.
Well, they go into something called the treasury shares, if you follow the American accounting rules. So they don't have to liquidate them, but they become treasury shares. They become owned by the company itself. All right, they're not traded anymore. So if you calculate the earnings per share, you will divide by a smaller number. Earnings per share will go up. The PE ratios are typically pretty stable. So if you apply the same ratio to a larger earnings per share, your price will go up. So that's the way to compensate the shareholders. So they hold the shares, they don't sell them, but their shares become more valuable because you have fewer shares now in the company. So that's one of the ways to do this. But the company needs to know how much to pay for the shares. What's the fair market value of the shares? And that's where the discount rate comes in. And that's what we'll do later today. Calculate the company value, company per share value, and then what? To repurchase. So if you calculate that the fair value is $50 and the market is trading at 60, you shouldn't purchase. The market is overpricing your shares, so the company shouldn't go in and repurchase shares at any price. So to determine the correct fair market value of the shares, you need a discount rate. All right? So that's another application, estimating correct risk-driven discount rate to value the company, to value shares, and determine what's the maximum price the company should pay for its own shares when it repurchases shares. Okay, so that's another application. Any other applications mentioned in the case in addition to what Natalia mentioned?
They also mentioned the performance review and benefits for management.
All right. Can you give us a little bit more? How does it work? Do you know?
Well, I think we have calculated the cost of capital, and then if the manager achieves, we calculate what revenue we achieve in invested capital, and if this revenue is higher than our cost of capital, then managers done a good job and they would get a bonus probably. If their return on invested capital is lower than the cost of capital, then it's bad for them.
Directionally, that's right. Just the terminology a little bit off. When you say revenue, you calculate
Return.
net income. Net income.
Yep.
Okay, so not revenue. So make sure to use the correct part of the income statement. Anybody familiar with the concept of economic value added? You have a hand? Or was it just okay? It was an involuntary hand movement. All right. Economic value added. Andrei?
Yes, there's a metric, economic value added, that might be used to evaluate the performance of the division. And they use the EBIT without tax, and they used also this weighted average cost of capital combined with invested capital amount. And if we subtract from EBIT without tax, It's also called net profit after tax, like their other name. And then they can evaluate this metric EVA to determine the performance of the division.
Okay. It could be division, could be the whole company. All right. So we'll get to the division level, but let's talk about the level of the company. So again, a hypothetical question. A company generates $1 million in net income. Is the company profitable?
We don't.
First,
And
yes.
obviously there is a trick there, but Anastasia?
I just wanted to say it depends on the cost of capital.
Okay, and cost of capital and
Taxes.
Cost of equity.
The size of investment.
the size of the capital in this case. All right. So if the company is $1 billion company and it generated 1 million, so $1 billion means the equity value is $1 billion. So the company invested $1 billion total. That's the value of the company. And you generated $1 million. What's your return on equity?
1%.
1 million out of $1 billion. You need a calculator?
0.1%.
So do you think that's enough to jump over the hurdle of the cost of capital? Very unlikely. All right. So let me demonstrate this on a very simplified level. So what I will do, I'll go into the example of the financial statements I gave you early in the course. So this is the data case. So let me do this. So this is the Lockheed Martin data. Okay. And so let me get the numbers I need. So I need net income. So I need to go down and look at the net income. So that's the numbers I'm looking at. So this is the company generated net income. I will do this on a book value, but you will see how this works with market values again. So what's the total equity invested in this company? So total shareholders equity. All right. So remember how this is calculated. All right. You have this much equity at the end of 2023. Everybody follows? All right. Let's assume that at that point, the WACC, and we can do actually, do a real calculation. Let's do a very simple assumption that the weighted average cost of capital for the company at the end of 2023 is 10%. All right. So given this amount of equity and given this weighted average cost of capital, all right. So actually, this is should be the R of equity in this case. We're not talking about the cost of debt. So based on the cost of equity, 10%, how much the company is expected to generate in net income based on the 10% expectation. So we would need to go in and say, okay, we will have this much in equity. The expected is 10%. That means we would need to generate this much as a minimum, 10% of the total equity. The company actually generated what? Almost 10 times that. So the company generated, let me insert, economic value added They generated 5.3 billion. The minimum expected was 683. So the company generated economic value added of $4.6 billion. So this is the minimum required. This is what they actually generated. That means they created economic value. If they created less than 683, the economic value added would be negative. That means what? The company destroyed value, not created value. All right? And how managers are measured? This is their measure. But the details should be very clear here. The cost of equity should be not today, but at the point when the goals were set for the senior management. So not at the right now, but at the end of 2023, did they meet the economic value requirements in 2024? In this case, yes. Okay, but obviously, again, I'm using the book value. I would need to go back, see what was the market value at the end of 2024, and I think I have this. Market value is 2023 is this. All right. So if I use this particular measure, so what's the minimum I need to generate based on the end of 2023, and I use the 10%. So that's the minimum based on market values. All right. Now, if the expectations are they generate 10% of the equity, the $10 billion, and they generated how much? 6? I'm sorry, 5. Did they generate economic value? So let's say the expectations were, let me go back here, 10 billion. So that's the expectations. This, they actually, what they generated. So the economic value based on market value is actually what? This minus this is a negative number. Was the company successful in meeting the hurdle rate?
Nope.
You see how that changes if you change to the market values? So if the expectations were 10% of the market value to generate in the next year, the company did not meet that goal. That's how you measure what the performance. And again, if you go down to the division level, you would need to use the cost of capital for that division to calculate the economic value added. Does it make sense? So a very critical measure of management performance, but you need to be aware of the timing. So you don't do today's equity with today's cost of capital, because remember, cost of capital fluctuates all the time, right? So you need to step back in time and say, all right, for 2024, did the management meet its expectations? So you do the end of the 2023 market value of equity, the cost of equity at that moment, and then you measure what happened in the next year. So that's the application of the cost of capital for the measuring the performance of the company's management. Make sense, Anna?
Yeah, I have a question about this performance assessment. What if there is like some crisis in the middle of the year? It's global crisis, not for the company. And how do they can meet expectations set like of a year ago when the situation was different? Like,
obviously, it's not the only measure of performance. Okay. Anybody heard about MBO, management by objectives? Some of you. All right. So I would sign it every year. My MBO, I would have like 5 objectives. Obviously, I do not run P&L. I do not run, profit income. Okay. But I would have my own MBOs tied to some, performance matrix. Okay. So it's not going to be just one thing, the EVA, economic value added. So if there is a crisis, and think about, especially in Ukrainian settings, what if the currency exchange changes against you? All right. Do you control currency exchange rate as a manager? Well, obviously, if that goes against you and the net income drop because you cannot sell for the same amount of dollars because of the exchange rate, it should be adjusted. And there is a way to technically adjust that particular number, especially for the exchange rate. You go back and you use exchange rate at the beginning of the year, not at the end of the year. Okay, because as a manager, you do not control exchange rate. So most of the companies, when they do these performance evaluations, they try to measure something that managers is in control. So if that that matrix is not achieved, obviously you don't get the bonus and so on. But if this is not driven by you, you're not controlling the worldwide economic crisis, that should not be counted against you. Does it give you the answer?
Yeah, thank you.
All right. So that's the approach. That's how companies use the cost of capital calculations. So we talked about the capital budgeting, the M&A, the stock repurchases, performance evaluation. One thing that kind of briefly mentioned there, not without any details. Remember we mentioned the goodwill on the balance sheet, how the goodwill, where does it come from? When company buys another company and they pay more than the book value of that company, the difference will be booked as a goodwill on the balance sheet of the buying company. Remember that accounting details? Okay. Historically, the goodwill will be amortized over 40 years. Those rules changed. Okay. And now those intangibles are sitting on the balance sheet until when? If the company determines that the value of those intangibles declined, okay, it's called the impairment of intangibles. The value, the impairment, the value declined. How do you determine the amount of impairment? How much you need to write it down? So you need to calculate the expected cash flows that intangible will generate. You need to discount it back to present and see what's the value of that intangible. So very similar to capital budgeting, it's just a different purpose. You estimate is the value of intangible is still there. But for that exercise, you needed the discount rate. So that's another application of the cost of capital, okay, to determine the value of the intangibles. All right. So let me, so that's the first part. Let me get into the calculations. So let's get into group 3. Let me see. Your calculation. So why don't you walk us through the corporate calculation, including the market risk premium that you used. So group 3, just walk us through.
Yeah, hello. Should I share my screen? Oh,
ahead.
how?
Yeah, go ahead.
Okay, let me share my screen. Yeah, let's start from the calculating. We need actually weights here, weights of equity and weights of debt, and we calculated it in 2 ways. With the one way is just to take numbers that were presented in the table 1 here, consolidated, and another way is to take shares outstanding and share price to calculate MVE. And then also for that, we used the book value, as you suggested on the previous lecture, because we do not have data about the market value of the debt for this company. And this way, we've calculated another way weights for the cost of capital, and they are really similar here.
Okay.
Yeah. So for tax rate, we've had like discussion. We are not sure. So in the description of this formula, we need to use marginal tax rate. But there is no mention about marginal tax rate in the case. So we have effective tax rate we can calculate from financial statements, or we've taken like we know that in 2007 it was 35% corporate tax rate, and like our assumption is that local tax rate is 5%, so we've took 40% as our marginal tax rate.
Okay.
Risk-free rate is mentioned in the case, and we took beta for the company also in our exhibits. We've taken market risk premium that was taken by the company itself for their calculations, and then we've had for equity all the stuff needed for equity, and for that spread to treasury also mentioned in the case. So we've had two similar numbers here for the company.
Okay.
Yeah.
All right. So you came up with close to 8%.
Yeah.
All right. Any comments from other groups? So this is kind of a mechanical walkthrough. Anastasia?
Yeah, so my comment is first of all regarding beta. So we actually have another one because we unlevered the beta of 1.25 and relevered it. And we had like the result was, if I'm not mistaken, let me see, 1.36.
All right.
We also
Can you add more details? Why did you do this? What was the reason for unlevering and relevering?
Yeah, so actually we're not sure if it's like a correct way of doing it, because we also had this discussion inside the group where the one part of our team was just for getting this beta from the case. But nevertheless, we decided that it should be a good approach because then we should use a different capital structure to relever it. Like,
okay, so I'll come back to that. Let me hear from Maxim.
I also agree with Anastasia and with her question, but also wanted to mention about MV debt, because he was mentioned in one of the exhibit, and that there was calculated as net debt, and there was extracted cash and restricted cash, and also there were presented MV at the date that applicable for us.
All right. Anastasia, what group are you?
Group 2.
And Maxim?
Group 4.
And Marco, go ahead.
Yeah, I faced the same problem as Anna mentioned and Maxim regarding market value of equity, because you could come up with that number from different sources. So to be specific regarding what Maxim said, we have Exhibit 5, and equity market value for the whole Midwest Energy Resources is stated there. And in a note below the table, it's stated that market values are based on the end of 2006 year's closing prices. So I believe that that was the most credible resources, because another one exhibit where we had share prices, it was stated just for the last quarter of 2006. So we don't know specifically if this average for the quarter or closing or open.
Okay.
And
Marco,
that's resulted in maybe a few percentile points away from that WACC.
Okay. Marco, what group are you?
Group 6.
Anastasia, have another comment?
Yeah, if I may comment as well, we have difference in market risk premium. So we actually decided that the 6% will be more appropriate here, mainly because of historical data that was in the case, and the average market risk premium, from 1987 to 2006, was 6.4%, which exceeded assumed by Midland 5%. So our assumption was that, taking into account increased market uncertainty, the higher market risk premium would be more appropriate in this case.
Okay. Good comment. What group are you?
Group 2.
Group 2. All right. Any other comments?
I would like to just to add why we taken 5 here, because it was part of the second point. Is it appropriate or not to take 5? So we've looked into the historical data, and it's in the middle of this confidence interval, and it looks okay. And we've looked into experts' opinions, and experts suggested a lower value for market risk premium, and as far as I understand, these historical values take into account some periods of high inflation and all of the, really disturbing times, and the experts take into account what they are expecting in the next year because of their experience and all of that. And this 5% is actually higher than what suggested experts. And for me, it looks like conservative choice, but maybe it's maybe because we've had a discussion about this, not all the group agreed that it's the best choice. But what is your opinion?
I'll come back to this. So let's hear a couple more students. Danilo, you were first, so go ahead.
Yeah, actually, we also have some discussion on some metrics, and I also want to hear your opinion about T for 40%, because actually we can calculate tax rate from, if I'm not mistaken, Exhibit 2, and divide taxes by income before taxes, and we will get almost 38.5%, but over previous years, average percent will really be really almost 40%. But in general, I want also to hear whether it's right or not to use 40% or to use taxes divided by income before taxes.
Okay, something that I will come back to. Last comment, Mitra. Danilo, what group are you?
6.
Group 6. Okay.
Yeah, I would like to elaborate on this market risk premium. But more in the context of first question, how these anticipated use cases affect calculations. We figured out that managers generally would like to get paid better and would like to get bonuses. And the lower weighted average cost of capital would be put in expectations, as they're more likely that return on invested capital will be higher. But in the same time, lower weighted cost of capital would lead the company to picking up weaker projects and actually destroying value.
All right. Dmitry, what group are you?
7.
Group 7. Okay, so let me step back and talk more about the and I keep this for now because I will refer to it a little bit. So let's start with the weights. And there was a comment: net debt versus gross debt. To treat it, if you do it net debt, remember what's a net debt? Net debt is a total debt on the books. We use the book value minus cash. Okay, maybe not all cash. That's a separate discussion. We'll talk about this when we do the company valuation. How much cash to use in this? But if you do the capital structure based on a net debt, all of your calculations, the weighted average cost of capital calculations, the weights must be on a net debt basis. All right. So you must be consistent. Either way, you can pick the net debt or the gross debt. Okay. But as long as you're consistent in your cost of capital calculations and the capital structure, this is really doesn't matter. Okay. But let's talk about capital structure. And that's where the unlevering, relevering things come in. All right. So what do we have? We have 56% equity and 44% debt. Okay. This comes from the company's data. All right. What if the company says the following? Our target capital structure is 60-40. Which one do you use? The one that you see in the numbers calculated based on the company's data, or on the declared target? What do you think?
Probably declared target.
Why? That's right, but why?
Because it's they know better what their actually numbers are.
You have to keep in mind the purpose of the whole exercise. What are we trying to do? We try to estimate the value of something, either a particular asset or a whole company. And we estimate future cash flows. We need to apply the appropriate discount rate that will reflect the risk of those cash flows. So we need to use as much future expected values as possible. So if the company declares this is our capital structure target, we should assume that the company will achieve it, and that's the future future capital structure. So that's the relevant weights. All right. And how does it play out with the inputs in your calculations? So remember, the beta with given capital structure is 1.25. That's given in the case. But that's assuming the capital structure as exists in the past. If you change the capital structure, what do you need to do?
We need to unlever current beta and lever it to different capital structure.
Everybody follows the logic of this? All right. So the 125 will not be a correct beta going forward because your capital structure changes, even just a little bit. Okay. So you need to unlever the beta, calculate the asset beta, and relever it with the target capital structure, because that was more likely to be relevant going forward. So that's the kind of the logic behind the unlevering, relevering. Make sense? All right. Market risk premium. So Anna, you can stop sharing. Let me get. I'll spend a couple minutes before we take the break. So where the market risk premium comes from, and that's the a little bit of a discussion is worthwhile here. So let me do this. All right. How do you estimate a market risk premium? So before I get into the table, you can ask people. You can do a survey. I sometimes get a survey as a finance professor. What do you think about the appropriate market risk premium? I can ask you. What's your personal market risk premium if today's, again, in the US economy? So risk-free rate is 4% today. We'll get to that. How much more would you demand in premium if you invest in the stock market? Stock market is riskier. So I can ask each individually. That's why I wanted to have a poll. That doesn't work. But think about this. Your individual risk premium might be, 10%. You are very risk averse. You demand a big compensation for taking the risk. Other, people in this class might say, well, 2-3% is enough for me. You're not very risk averse. You follow it? Okay. And I can ask everybody to take the average and say, all right, it looks like the market risk premium in this room is on this Zoom is 4%. Okay, or it could be a 7%, depending on the what you personally think. So let me share something here. But whose opinion is more important? A student in this classroom or a billionaire that is trading on every day? Obviously, that person expresses his or her view through actual trading, and they have expectations. All right, so it's not a democracy. The more money you have to trade, the more view is important. All right. So for practical purposes, what do? We go to history and we say, okay, so this is the data that is available. So what happened when CAPM was developed in 1960s? The Ford Foundation gave a big grant to Chicago University, and it's a separate company now. But originally, Chicago University collected the stock prices and all prices, including risk-free prices, historically going back to 1920s. So in this particular table, what do? The stock market, the S&P, returned this much in 28 before the crash. The risk-free rate earned this much. So your risk premium in 28 was this much. Then the crash started. You see the Great Depression. You can still calculate risk premium. It's negative, but you have a historical data all the way to the last year. And you can calculate the risk premiums for each year and take the average. So the stock market earned about 12% historically through all the period. The risk-free rate earned this much. The difference is 7% historically. I did this for 50 years, and you see it's almost identical. I have to give you 2 decimals to show the difference. Okay. For the last 10 years, here's the risk premium, much higher. But obviously, statistically, if you look at the number of data points you have, your standard error will be smaller the more data you have. All right? So this is statistically a better estimate. The more data, the more stable is your estimate. And this is the arithmetic average. You can calculate geometric average. I'm not going to get into this controversy, which is better. But the risk premium using geometric calculations is about 5.5. So the range, somewhere between 5 and 7% historically. The question that logically comes up is the following. What are we trying to do? We're trying to estimate the risk of investment going forward, the premium going forward. And yet we go turn around and look at 1928. So a legitimate question will be, how relevant is 1928 to 2028? See, we're trying to look forward. So, but yet we take the historical data and look backward to the expectations that the data will be stable historically. There will be a reversion to the mean historically. So, one of my, purposes of my PhD dissertation, I looked at the data in 1860s, okay? Going back more than 90 years that we have in the US market. I went to London Stock Exchange and collected data on London Stock Exchange from 1860 to 1930 to extend this to have a better statistical estimate. But then again, the legitimate question is, how relevant is 1860 to 2050? Okay? And it's a legitimate question. So how do you, imply it in practical terms? And a legitimate, reasonable range between 5 and 7% will be perfectly okay. And here's another quirk here. It really doesn't make much of a difference in certain scenarios. So think about this. You have 10 projects, and let's say some theoretical true premium is 5.5%. And you, in your calculations, plugged in 6. What will happen to the ranking of the projects based on NPV?
Nothing.
Nothing, because what? You consistently apply too high of a rate, all right? But the ranking, the best project will still be a best project. Does it make sense? All right? So again, do not get hung up on it must be reasonable. If you plug in the market risk premium of 15%, I will question it if you do it on your final submission. Okay, if you plug in 2%, I will question that number. But if your market risk premium is between 5 and 7, that will be acceptable. Make sense? 15-minute break. All right, let's resume. And a couple of questions. So we talked about the target capital structure. We talked about the equity risk premium, market risk premium. Metroy had a question?
Yeah, while we're still there, I would like to better understand market risk premium. When you showed us historical data, and there was entry for Great Depressions, the risk premium there is negative. How to understand this? From formula, yes, it's negative, but like if we are a firm, we could enjoy discount in the borrowing rate compared to like bonds.
Again, historical data is used to estimate the average over a certain period of time. Okay, individual negative numbers, negative risk premium logically make no sense. Okay, but it did happen. Okay, so the idea is we're not estimating a 1-year market risk premium. Remember, in our calculations, we have multiple years, and as we go for company valuation, it's an indefinite time series. So it's not a 1-year thing. It's a historical average over many years. And even though you have negative numbers, it did happen. All right? So you should not exclude those numbers from your calculations.
But if we add them up, and if we have multiple depressions, etc., so the worst economy we had in previous years would make current risk premium cheaper?
Yes. All right. If that's what investors accept as a little market risk premium historically, that's might be the case going forward. Okay? So there's it's just a statistical artifact. Okay. One way to estimate market risk premium is something called the implied market risk premium. Anybody familiar how this is calculated? All right. So it comes from Damodaran, Professor Damodaran at NYU. He kind of demonstrated this concept. What's the implied market risk premium? Do you know the value of the, let's say, the market today? It's a market value. You can easily count. You take 500 companies, take share price, multiply by the number of shares. It's a bit of work, but it's easily done. Do you know the market value of the market? All right. Can you estimate expected cash flows for the total market? That's what you will be doing for your individual companies. You just do it 500 times, you get the expected free cash flow for 500 companies for S&P 500. Is it doable? All right. Can you estimate what must be the discount rate to bring those cash flows to the market value of all 500 companies? Can you estimate it? Can you extract the discount rate? Sure. Can you calculate market risk premium, which is embedded there? Because remember, what's the beta of the market? By definition?
One.
All right. So you can easily calculate what must be the market risk premium today, given the market value of all companies and given the expected cash flows. So you can extract that market risk premium from this calculation. Just it's an equation with one unknown. It's easily done. You see that? So this will be called the implied market risk premium. So that's what investors today, given the value of the companies, given the risk-free rate, you can estimate it. Okay, so that's another way instead of going back to the historical data. Okay, and I guarantee it's not going to be a negative number. Okay, so there is a way to handle this in different ways. So a typical you join a corporation, and the finance department of the corporation will tell you, here's the market risk premium we use in our present value calculations. And that rarely changes, maybe once every few years. Make sense? And again, the reason for that, if you miscalculate it a little bit, the market risk premium, your ranking of the projects will still be the same. You still pick the best project. Okay? As I go through this, the tax rate. Okay, so what's the appropriate tax rate? And Anna already said that there's an effective tax rate. There is a marginal tax rate. So effective tax rate, you take the income tax paid divided by pre-tax income, and you calculate what the company actually paid. That's the effective rate. Okay. In estimating the cost of capital, the marginal tax rate is applied. Why? What does it mean, the marginal tax rate? That's the tax the company pays on the marginal, every additional dollar the company earns. Okay, it might have some deductions for different purposes, the research and development. The government has a very complex tax system. But what are we trying to do? We're trying to estimate the present value of future cash flow of a new project. That's an additional dollar that the company earns. Okay, and that rate, historically, why 40%? At the time of the case, the federal tax rate was 35%. plus state taxes, and then you get to 38-40%, all right, on average. So that's why the marginal, whatever the marginal is, and when I joined the bank years ago, I was the one who would send the marginal tax rate to the whole of the corporation. All of the finance professionals in the corporation will get an email from me. For next year, marginal tax rate is 38%. Okay, so for all of the projects to be consistent, that was the rate. Today, in the United States, the federal tax rate is 21%, plus 3-4% on average state taxes. So about 25% marginal tax rate will be appropriate for the U.S. company, unless you do Apple. A big chunk of Apple's business is legally located in Ireland. Their tax rate is 12.5%. So it's very likely their marginal tax rate will be lower than 25%. All right. So, but again, you apply the marginal tax rate, not the effective that happened to be in a particular year. Does it make sense? All right. So let me, I'll show you the numbers for the corporation and for the divisions. I'll go through some slides before we get to the company valuation. But let's conceptually, I think, let me see. All of the groups have spoken except group 5, I think. Do we have group 5?
Yes.
Why don't you take on the last question? How did you estimate the petrochemicals cost of capital? Walk us through the logic there.
That's exactly our favorable question.
Okay. What?
So will you answer, or maybe I?
Maybe you can start. I will support you.
Okay, so first we started with evaluation of beta, and we chose 2006 year, and it was like challenging to find the data from this year. But we managed. There was like we tried to find companies totally operating in petrochemicals, but it was also challenging. So we started like with some Saudi Arabia, Exxon, and so on. So we calculated beta and leveraged them regarding the taxes in the countries the company are situated, and D/A ratio of those companies, and actually those unrated, already unrated beta we put into our CAPM model and calculated marks for the petrochemicals.
Okay, so it looks like you did it the hard way. There is an easier way. So let me step back. I'll walk through, I'll share the slides with you so you will have the numbers. You can compare to your numbers. And again, by the end of Saturday, you owe me a one-page summary on our discussion and the calculations. So I'm not going to do all of the calculations walking through. I'll show you the numbers. You will have access to those to work with. So let me get into the summary. All right. So we talked about the applications of the weighted average cost of capital calculations. We talked about capital budgeting, financial accounting. You don't need to know this financial accounting standard 142. This is a purely American thing. This is about the impairment calculations. Okay, we talked about M&A. We talked about the economic value added and stock performances. The basic idea is that this represents the measure of the risk of the future cash flows. All right. So that's the purpose of estimating the weighted average cost of capital. So again, my calculations based on net debt as given in the case. So if you did in a gross debt, perfectly fine. Your numbers will be somewhat different. Okay, but that's fine. All right. So if I go through these calculations for the company, you are given the corporate level cost of debt. You're given the beta for the company. But again, the point. So if you plug in those numbers with these weights, you'll come up to about about 8.25. Okay. If you have different weights, your number will be somewhat different. Okay. The point I was trying to make, could be wrong. This number will change if you change the weights to the target. Okay, so that's the idea of what unlevering this beta, calculating the asset data, and relevering with the target capital structure. So that's the adjustment would be appropriate in this particular scenario. Okay, so the inputs, we talked about this last week. General inputs are the weights of equity and debt, and the calculation of the cost of debt and equity. The cost of equity is based on CAPM calculations. And again, if you need to relever, unlever, that's the formula we use. Okay, cost of debt is typically the same risk-free rate as in CAPM, but the default premium is typically estimated based on yield to maturity in the market. If that is not available, one of the estimates that something that you might do with your individual company analysis, you calculate interest rate coverage. I will give you a table where you will estimate risk premium based on that ratio. Okay, and that will be plugged into the cost of debt here. All right. Now, this formula, I'm not going to get into every single step, but the idea is the following, where that formula comes from. When you have debt, so no debt, obviously that formula, if you have debt zero, that term disappears, and these two parts are the same. Okay, but as long as you have debt, and what happens when you have debt? You have the interest expense. You lower your earnings before taxes, and you lower your tax payment. Okay, the corporation will save money. It's called the tax shield. Just to make sure this is clear, we're talking about investors, both debt investors and equity investors. So for all of the investors, there will be savings, corporate savings, and that generates a tax shield. So we say it, the corporation will create additional value called the tax benefit of debt, because you're saving your tax payments. And again, it doesn't come from nowhere. What is the source of this additional value that corporation creates by borrowing money? They pay less in taxes. So the government collects less money. That's the source of additional value. All right. So I'll go through some algebra here. I'm not going to replicate it. If you're interested, go through. And that's where this formula comes from. But there are certain assumptions there. The company is profitable. Because if the company is not profitable, if it loses money, you don't save on taxes. You don't pay any taxes. All right. So that's one of the key assumptions, that it doesn't work in all scenarios. If you have an unprofitable money-losing company, that formula doesn't apply. Okay, so it has to be profitable company. If that's the case, the tax benefit will be created. That's the additional value, and the idea, and that applies to that calculation for the petrochemical company. The beta of assets and the beta of all liabilities and equity is the same. That's the accounting and identity. All right? But the assumption is the following. The beta of debt, the assumption is that the beta of debt is zero. So what does it mean that the beta of debt is zero? Remember what the beta, how do we measure beta? What did you do to calculate beta for your company? you run a regression. And remember, I asked you to look at the R-square, the correlation between the market and the explanatory power of market on the company. So the market is up. If the company up more than the market, the beta is more than 1. If the market is up, but the company is up less than the market, the beta is less than 1. Now think about debt. If you run a regression of the value of debt versus the changes in the market. Market is up. What happens to the value of debt of the company?
Nothing.
That means what's the correlation? Statistically, it should be close to 0. So when you run a regression, the coefficient of X will be 0. So that's the assumption that the market is fluctuating, but the value of debt is fixed. That's why it's called fixed income instrument. All right? So the assumption, and it's a reasonable assumption, that the beta of debt is 0. So if you go back to this a table, so if you assume that the beta of debt is 0, that means the beta of equity will be higher as long as you have debt, because this will be a combination of what? Of the asset betas and the tax sheet. All right. So that's where this formula comes from. So again, a couple of assumptions. It's not necessarily 100% cases that the beta of debt is 0. It can be positive in very special circumstances. And those circumstances will be if the company is over-levered. So think about this. If the company has a ton of debt, the market is up in good economic conditions, that means the probability of bankruptcy is lower for the company. That means the value of debt might go up. So market up, the value of debt is up. But only in those specific circumstances when you have a big proportion of capital in debt. Extreme. All right? In normal circumstances, the beta of debt is 0. But in some cases, when you have a lot of debt on the balance sheet, it might fluctuate with the state of the economy. In good economy, the value of debt will go up. In bad economy, the probability of default will go up. The value of debt will go down. Okay, so again, just keep that in mind. So the assumption is in normal economic circumstances, the value, the beta of debt is 0, and the company is profitable. It can generate tax savings. If those conditions are not met, that formula doesn't work. Okay, so just make sure this is clear. The calculations, let me go through, and again, I'll give you the numbers. So for the company, how do you calculate the division cost of capital? So you are given 2 samples, right? One is for exploration and production. One is for refining and marketing. You are given the data. You can calculate the asset beta. You can calculate the levered beta based on the capital structure given in the case for each division. So that should be pretty mechanical. We did this exercise last week on unlevering, relevering. So you do this. One comment here. And the comment is, what are the comparable companies? All right. So this looks a pretty similar size. If you look at this sample, you see one company which is kind of looks like an outlier. All right. The general bias should be to keep as many companies as possible. They must be in the same industry, but they must be comparable. And it could be argued that this particular company is an outlier, and it might be okay to get rid of it. All right. So my calculations will be what? Excluding this particular company. Obviously, this number will change. So this will be 105. including that smaller company, if I exclude it, obviously my estimate changes. So I use this particular estimate to calculate the cost of capital for this division. Okay, so keep that in mind. Petrochemicals, how do you do the last one? Well, remember the betas for the company are the sum of the weighted betas of the divisions. So you have multiple divisions, you have multiple betas. All you need is the estimate of, like in this case, we have 3. Okay, so you have weight 3 and beta 3. If you estimate one beta and the second beta, and you estimate the weights, you will have an equation with one unknown. So you can easily calculate this one if you have the rest of the variables known. Make sense? Obviously, the question is, what are the weights? So in this case, again, unlevered beta for the company, if you take that 1.25 unlevered, you will get about 0.92. You have the betas of the 2 divisions. Okay, the weights, I use the after-tax earnings for the total company. So those are the weights in the earnings of the company. You can go up, to revenue, but what happens? The profit margins are so different between the 3 different companies, 3 different divisions. So revenue will not be an appropriate weight. Okay, you have to go all the way down to after-tax earnings to have an appropriate weight in this particular calculation, and that's what I use. So I calculated the betas for the first 2 divisions. I calculated the weights based on that earnings, and I apply that. So that's my numbers for the weighted average cost of capital, and it happened to be the lowest number. Okay. Again, I will post it for you to review and see if you need to make any corrections. Again, your summary is due by the end of Saturday. Andrei?
Yeah, I have a question. Can we go back to the slide with comparable companies information, please?
Just a second.
What is the purpose of having average asset beta if we used average unlevered beta when calculating relevered beta for our divisions?
Try again. I don't follow your question.
Well, this asset beta, this is levered, like beta levered, yes? As I understand.
Asset beta is unlevered beta.
Oh, already unlevered, yeah.
So
Okay.
equity beta is levered. So whatever the leverage of this individual company, you unleverage using that formula. And remember, as long as you have any debt, your asset beta, your unlevered beta will be lower than the equity beta.
Yeah, okay. Thank you. Thank you.
Other questions? Stanislav?
Yeah, so it means using this formula. If we substitute all the debt with equity, we'll have our equity equal to the asset equity, yes?
Again, remember that formula, debt divided by equity?
Yeah.
If you have no debt, that ratio disappears, and then the 2 betas are the same. Okay, so a company that does not have any debt, the asset beta and equity beta will be the same thing. As soon as you start introducing debt, and that's something we'll discuss next week, that's the corporate decision making. Okay, and I will ask you on an individual project to address that question. Okay, so as soon as you start adding debt, your beta will change, your equity beta will start going up. Why do companies do this? Remember, you're adding a cheaper source of capital. So your overall weighted average cost of capital starts to go down. What will happen to the value of the company?
Go up.
Will go up. So you can increase the value of the company by purely financial means. You start borrowing money and the value of the company starts to go up, but not forever. So that's something that we will discuss when we talk about the capital structure. Okay. So it is the, sometimes it's called the financial engineering. You increase the value of the shares by borrowing money. It sounds kind of counterintuitive, but that's why companies do it. All right, Andrei?
Yeah, I'm sorry. I once again wants to go back to my question, but in the case in Exhibit 5, we get average of equity beta, like levered, and I was wondering why we get this information and for what purpose we can get this average of equity beta. Like we don't use this number.
Hold on a second. What do you see average equity beta?
In the case, I thought that we have equity beta average on the page 11 of our case. Like
Okay.
they give us average equity beta, but we used average asset beta for relevered.
One of the ways to calculate asset beta will be to take what? Average equity beta and unlever it with the average DE ratio. So that's one of the ways to calculate the asset beta. And it's okay. All right. I prefer individual, but you can't. But again, you cannot use individual debt to equity ratios. You would have to use the average.
Okay, it's like a simplified version, yes.
That's right. That's right. You kind of skip a little bit of calculations, but that's perfectly fine.
Thank you.
Okay, Maxim?
I have a small question. Can be the situation when the cost of debt is higher than cost of capital?
That will be very unusual. It is possible theoretically, all right? When we talk about the capital structure, you will see that as company borrows more and more and more and more, because risk becomes higher, you might see a higher cost of debt than the cost of equity. But again, that will be very unusual. Because remember, you have tax deduction, 1 minus T there. Okay? So you might still have a lower cost of debt after tax. Make sense? All right, let's Dmitro, last question and we'll move on.
Probably to elaborate on Maxim's question, if company have unusually low cost of equity, then it could just give debt to other companies and make money of it. Buy debt of other companies, I mean.
That would be an interesting thing, but that typically doesn't happen. Let's come back to this when we discuss the capital structure. Okay, next week. All right, let me walk through the company valuation template just to add a few things that you need to do to change from project analysis into a company analysis. The starting point is exactly the same, all right? And let me get into the company valuation. I'll talk about two main concepts here. Valuation, typically three approaches apply. Discounted cash flows, relative valuation, and contingent claim valuation. This is something we will not do. We will not do option pricing in this class, but this is call and put options. Some of you might be familiar with this. We will concentrate on these two approaches. Okay. The discounted cash flow approach, you already have seen it. Okay. The difference is in the project analysis, you have a specific number of cash flows. It's a 4-year project. You know, in Ocean Carriers, it was a 25-year project, but you still have an ending date. All right. When you do company valuation, N can be an infinity. Why? a company might exist forever, theoretically. So we need to account for this in our calculations. Okay, so that will be one big adjustment in our work. But otherwise, the process is exactly the same. You estimate cash flows for each period. You estimate appropriate discount rate, apply that discount rate, calculate the present value, and then sum up all of the present values to calculate the value of the asset or the value of the company. Okay, this typically works best. What's the advantages of the DCF, discounted cash flow valuation? If you have a profitable company that exists for many years, you can estimate the future cash flows. You can estimate the appropriate discount rate. So for mature companies that generate cash flows, that's one of the reasons I ask you to pick a profitable company for your individual project. That works best. The downside, actually the benefits, the pluses of DCF valuation, one of them is you getting to know the business. You're getting into some very minute details about the cash flow generation, the revenue, the cost of revenue, all of the expenses. So you're learning something about the business. But that can be a downside as well. Why? Because by estimating so many parameters, you create a lot of noise. Because each estimate might have a distribution around the expected values. So a lot of noise can be generated when you do this multiple forecasts. Okay, so that's the difficulty. Again, not the reason to skip DCF, but be aware that you introduce a lot of noise around your estimates, and you need to deal with this. And sensitivity analysis, one of the ways to deal with it. Okay, to see what happens when you change your assumptions. Okay, when it works best, so when you need to estimate the fundamental value of the company, you have some good idea about the cash flows and the appropriate discount rate. So that's the best applications, and that's what you will do mostly in your final installment for your individual project. The way it works, very similar to what we did in the project analysis, with one big difference. It's an existing company, so you have the latest financial data available. Okay, and based on that data, you do a forecast. So I take the income statement as reported for the latest period available, and you forecast your income statement. And I show you 3 years, but what I have in mind, I have 3 stages. Okay, if you have a very high growth company, let's say it increases its revenue by 25% next year, doesn't have to be just 1 year, could be multiple years. All right, so I just demonstrate a stage, very high growth stage. Then the growth will decline to still double digit, still high growth, and then the company growth will moderate. And you estimate the rest of the income statement, as I said, as percent of sales. So you do some historical calculations. You say cost of sale is 60, SG&A is 20, depreciation is 10. All right? And you forecast it forward based on your expectations of sales. All right? But obviously, the company cannot grow faster than economy forever. So if economy is growing at about 4% growth rate, historically, you cannot grow faster. You have to assume that your growth rate will go down to the growth rate of the economy. And that's the key difference between a project analysis and a company valuation. You have to make a certain assumption, and that assumption will be that at the end of the forecast period, you will grow at a constant rate. So my assumptions here are the following: that after the forecast period, the free cash flows will grow at a constant rate of 3%. All right, forever. That's the infinity point, and we can use a growing perpetuity formula for that particular calculation. So we'll take the last cash flow will grow it at 3%. And again, 3 to 4% for a developed economy is a very common assumption. Okay, I'll show you some calculations later on the US. So you plug in, and again, remember in the growing perpetuity formula, the present value is equal to what? Cash flow 1 divided by R minus G. Okay, so how do we get to cash flow 1? This cash flow, we consider cash flow 0. So to get to the cash flow 1, you take that cash flow, grow it by 1 year, 1 plus G, and that becomes your what? Cash flow 1, and that will fit this formula. Again, make sure these variables are reasonable. Your discount rate, your WACC, your weighted average cost of capital, must be higher than G. Otherwise, the formula doesn't work. Okay? Using that assumption, you plug in something at the end, which is called the terminal value. So all of the cash flows after this year 3 will be incorporated in this calculation. Okay? The growing perpetuity. Why do you call it terminal value? Remember, my corporate finance class, the professor said, well, think about this in these terms. How much can you sell this company at the end of year 3? That company is growing at a constant rate. You can calculate the value of this company using growing perpetuity. So you can sell it for this much. That's the price of the company. So that's why it's called the terminal value. You terminate, you sell it for that much. But this will be becoming part of the incoming cash flows. So you're selling this company for this much. So you take the specific cash flows that you calculated, you add the terminal value to the last cash flow. This is your last cash flow. The rest is absolutely the same we did in the project analysis. You take each cash flow. It could be much more than, many more than 3 years. Yeah, it could be 10 years. But at the end, you still add the terminal value to your last cash flow. You discount each cash flow to present. You sum it up. And what you end up with, your NPV, remember I asked you to calculate enterprise value in your first installment of the individual project. This present value of all future cash flow is the enterprise value. All right? So we come to the same thing from a different direction. All right? But the formula still works. So this is the enterprise value. And remember, what's an enterprise value? The enterprise value is this. Market value must be market value of equity plus debt minus cash. All right? So if I ask you to calculate value per share, how do you calculate market value of equity? You take your estimate of the enterprise value and do what? Minus debt plus cash. And that will be the market value of equity. You divide by the number of shares, you come up with the value per share. So this is your template. That's all you need to do. Obviously, there is a lot of work building the income statement, estimating the revenue, the expenses, getting to the operating income, applying these adjustments. Let me talk about the adjustments. But mechanically, you adding the terminal value, you calculate present value of all future cash flows. That's the enterprise value. Do this reverse calculation of equity value, divide by the number of shares, you calculate value per share. And then, obviously, you compare this to the market price. You calculate the market estimated value per share, and you look up what's the trading price today. And if it's trading at 50, what do you say in your conclusion? The market is overpricing this company. If it's trading at 25, you say the market is underpricing, again, based on your analysis. All right. So that's what Wall Street analysts do. That's their template. All right. The details, obviously, the devil is in the details. So let me point out a few things. I'll add more when we do the company valuation next week. adjustments, the depreciation, change in net working capital, and CapEx. All right. So the framework is exactly the same as we did with the project. Anna, you had a question?
Yeah, sorry. I would like to ask you about these 3 years in the future. How we decide on growth rate? Because how we decide what will be the growth rate for the next 3 years?
You would need to kind of learn a little bit about the company. So, what do? You look at historical data. You don't have much of an insight. And if the revenue is growing at 10% in the last 4 years, do you immediately assume 3% next year? No, you would extend that 10% for year 2, 3, 4, 5. Okay, but then you would need to assume that growth rate will start to go down and settle on a constant growth rate. And a constant growth rate, as I said, again, if you do a Ukrainian company, that would be a different story. In the developed economy, 3 to 4% constant growth rate is pretty common. All right. But the number of years of more than 3 or 4% and the actual growth rate will be based on the historical data.
Okay, thank you.
All right. So let me. Question was if it's trading at 50 and you calculate 30, what do you do? Yes, you short sell it. You borrow the shares, you sell it at 50, and if your calculations are correct, you will buy it back at 30. The idea, we'll talk about something called the efficient market hypotheses in the remaining classes. So the idea is that the market is efficient in determining the correct prices. Okay, so if your calculation was correct, justified, market will eventually recognize the true value. Okay, not immediately. The market can be completely off for an extended period of time. But the hypothesis in academic corporate finance is that market will eventually get to their senses and correctly value the company. Okay, so let me talk about the adjustments and the difference between the project analysis and a company analysis. So depreciation. This should be pretty straightforward. All right. You estimate, and that's what I did here. Based on historical data, I said, okay, historically depreciation was 10% of sales. I will extend this 10%. Now, CapEx, and that's sometimes students have this difficulty. CapEx has to be at least as big as depreciation, especially in the terminal year. Why? Because think about this. What if I plugged in the following numbers? 15 for depreciation and 10 for CapEx. What's wrong with this assumption?
Depreciation cannot be more than CapEx.
Why? You're right, but give me the reason.
Well, since depreciation is like distributing the CapEx value over some time.
All right. So think about this. This number, this cash flow, will be plugged into a perpetuity calculation. Can depreciation be higher than CapEx forever? Logically, you will run out of things to depreciate. Because where's the depreciation comes from? You invest in CapEx, in the new equipment, and you depreciate it. But if you did not invest enough to depreciate 15, over a number of years, you will have nothing to depreciate. And I see this mistake all the time, even in some professional calculations. All right. So use the logic that CapEx has to replace depreciation. And if the company is growing, it has to invest more and more to support the growth. Okay. So that's where, in these assumptions, my capex is larger. When we get to the calibration, I'll show you how to do this. For now, just make sure that your capex is at least as large as depreciation. Stanislav?
I'd like to ask about this rules that we should maintain the capex expenditures at their higher rate or equal than depreciation. And it will be true in case we will have a perpetual valuation model. But what if in case we'll have like finite model where we can, is it possible to estimate the value of company using finite models?
I'm not sure when you say finite model, what do you mean?
So it's like in projects, we have like horizon of investing of free cash flows, like 10, 30 years or 25 years for ocean carriers. Is it possible that we can somehow like shorten this horizon for the company, or we always assume that it will like live forever?
Well, if you expect the company to shut down in 15 years, you can put the deadline saying, that's it, that's the last cash flow, 2040. But in most cases, corporations do not have an expiration date. Remember, I gave you an example of GE. GE was in the original Dow Jones in 1896. And it might go on for another 100 years. So how do you mathematically incorporate that future cash flows? And that's what you do with growing perpetuity. That's the formula that allows you to do it, to calculate the present value of all future cash flows, including the perpetuity. So that's the way to handle it. But you are onto something. Obviously, that constant growth rate is very controversial. And let me get back to this. If you eraser, let me get rid of this. It becomes too busy. So the biggest criticism of the DCF model, where is the biggest chunk of value comes from?
Terminal value.
All right. The terminal value, that's the biggest component of this. And that's what a lot of people are very uncomfortable, because you're relying on this mathematics to give you that number. Okay. And there is a different approach, and that's where I will introduce the relative valuation. And you will see in many cases, the approach, it's kind of a hybrid approach. Instead of using the growing perpetuity calculation, you use something called multiples. All right. So let me go through and introduce the multiples approach. So it's called the relative valuation. And the idea is the following. You know the value of something, and you can calculate the value of that something based on the ratio. So I use the real estate example, but the concept is the following. Let's say you have a company that generates $200 million in annual sales. And this company is listed on the market, it's traded, you can see the market value of 400. And you have a ratio of market value to sales of 2. Let's say you have a similar company in the same industry, does the similar thing, but it's not traded. But you need to estimate what's the approximate value of this company. And if that company generates $150 million in sales, and it's similar enough, you apply the same ratio of 2, and you know the company should be worth around $300 million. So you value this company relative to something that you already know the value of. Make sense? The mechanics of this is, so let me walk you through an example. You obviously need to go through a selection of the sample. So let me first do the mechanics of this and then come back to some details. We will be talking about this company in the last meeting, Kerr-McGee. Okay, it's an oil company, and the company is under attack from activist investors. Carl Icahn to be one of those. And the first question is the company underpriced, okay, in the market? Okay, why this activist investors is trying to change the strategy of the company? Okay, so what's the process? First, you select a sample of similar companies. So all of these are oil companies, okay, approximately similar size. So you don't see the major oil company. You don't see ExxonMobil. You don't see Chevron. They're much, much bigger. So those are kind of the smaller, this is the enterprise value. All right. And remember, what's an enterprise value? Approximately equity value plus debt, net debt. All right. So you can easily calculate enterprise value for all of the companies. Again, you use the public data, and then you collect some financial data, revenue, EBITDA. And remember, I asked you to calculate ratio of enterprise value to EBIT in your individual assignment. A similar process with EBITDA. You calculate ratio of enterprise value to EBITDA, to sales. So, but first you collect the data. Second step, you calculate those ratios. You take enterprise value from this column, and you divide it by revenue, you divide it by EBITDA, and you calculate ratio for each company. All right? And then you take the average. So this is the industry ratio of enterprise value to revenue. What does it mean? That in this industry, investors are willing to pay $3 for each dollar of revenue in the market value of equity plus debt. Okay? Or $4.80 for each dollar of EBITDA. You can also measure something physical, like in this case, oil reserves. Millions of barrels of oil equivalent. Again, you don't need to know the details because you have oil, you have natural gas, you convert it to the same measure. Okay? Barrel of oil equivalent. And you calculate the ratio of that. So you come up with $10.30 per barrel. Again, this is 2004, so this is much cheaper, but this is still in the ground. So you have to still extract it before you can sell it. That's why this number looks a little bit low. So that's the step. You collect financial data, you calculate the ratios, estimate the industry ratio, and then what do? You take the EBITDA of Kerr-McGee, you take the revenue of Kerr-McGee, you take the reserves of Kerr-McGee, those are the variables, and you apply the industry averages. All right? And you calculate enterprise value. Obviously, you don't get exactly the same thing, so you normalize it, you take the average. So the enterprise value, the estimated enterprise value of Kerr-McGee is $13.5 billion minus debt. Cash is ignored here. There's a small amount of cash there. We'll talk separately about this. You calculate the value of equity. You know the number of shares. You calculate value per share. And you compare it to what's in the market. And you say, yes, the company is somewhat underpriced based on this analysis. But you see, this is a much, much simpler approach. You go to the sample data, you calculate ratio, and within a very short period of time, you can calculate the value of the company because the DCF, you cannot do this thing overnight. This will require multi-week exercise to estimate every single input into the DCF. Okay, it does give you a lot more fundamental insight into the valuation, but it's a much more complex process. The relative valuation is much more straightforward. You calculate, you collect data, you calculate ratios, You apply those ratios to the company you're trying to value. And there is another point here to make is the following. So let me go back to the terminal value to this calculation. One of the ways to estimate the terminal value would be doing the following. Instead of this growing perpetuity formula, which is sometimes difficult to explain to people, what do? You calculate the value of the company using the multiples. So your terminal value will be what? A ratio, let's say, of market value to EBIT. You collect this from the industry and you say investors are paying 10 times EBIT in market value. So what do? You take the company's EBIT, multiply it by 10, and that will be your terminal value. So you avoid this big discussion about the constant growth rate, what's the appropriate growth rate, and so on. So this is kind of a hybrid combination. You still do the DCF, okay? But for the terminal value, you can apply the multiples instead of doing the terminal value as a growing perpetuity. So that's the approach taken by practitioners a lot. Anna?
Yeah, I would like to ask you about multiples. Something physical. If the company is gives a service company, what should be there? So if it's not oil company, I mean, how to choose the third multiple?
All right. Consulting companies.
Yeah, something like that. Mm-hmm.
Do they have EBIT?
Yeah.
Do they have market value?
Mm-hmm. I mean, I am asking about these reserves. What you choose for oil company? What should be for the service?
For the physical measure, it would be kind of difficult to do unless you come up with some big insight. But financial ratios, very easy to calculate. All right. For a company that deals with physical measures, obviously you can have that option of physical reserves. When you do the brewery, you can estimate the output of beer, okay, in physical measures. Consulting will be difficult to do that. Number of consulting projects, kind of a stretch. But financial ratios like EBIT to the market value, or market value to EBIT, market value to EBITDA, revenue, market value to revenue, that's pretty standard. Make sense?
Yeah. What do you think about Dmitro's proposition? Because he suggested to use headcount of consultants. Is it? Does it make sense?
A consultant at one company, I'm not going to name companies, is different from consultant at a different company. So would be kind of, no, you can estimate, okay, one consultant generates this much revenue. But a consultant with a big name company, with a no name company, will generate very different amount of revenue per consultant. So it will be tricky to use.
Okay, thank you.
All right. So I would rely more on financial ratios. Okay, so that's the introduction to the valuation. So again, DCF and relative. So the slides are posted there. Make sure to review before you work on the case next week. Next week's case standard. Read the case. Try to answer those questions as much as you can. There is one thing that I will try to see if you can figure this out. You do the valuation. The forecast is given to you in the case, in Excel file. It also includes one company is buying another company. And that company is planning to squeeze some cost to increase some revenues. So those assumptions are given there, all right, already in the forecast for you. You just need to estimate the discount rate, similar to what you did for Midland. There is one thing here, and something that we'll talk in some details about this synergy. So what happens when companies merge? One of the reasons, what's a synergy? So think about this. You have two companies merging. How many CEOs do they need? One or two? Not a difficult question to answer, obviously. One. What happens to the second CEO?
Deputy CEO.
He will be given the golden parachute of whatever millions of dollars, and that CEO will go away, retire. But what will happen to the CEO's salary of the company? It's a savings, because you save it this year, next year, and forever. So you have a savings of perpetuity. Okay, so when you plug in those savings in the perpetuity, you will create value. That's a synergy. Okay, one of the synergies, and see if you can figure this out. The company will reduce the amount of inventory they have, because their system is more efficient than the company they're buying. So what will happen? The inventory balance will have one-time adjustment down. And remember, a reduction in net working capital is what?
Increase in cash flow.
That will be the benefit. That's the synergy. So see if you can figure this out. It's not a critical part, but see if you can handle it. Obviously, we'll discuss this in class. But that's the most of the synergies are already there in the forecast. So calculate just the present value, go through the motions, do include the terminal value, but inventory management, see if you can figure this out. Questions? I'm done for today. I'll stick around for any questions, but you're free to go. And I'll see you next week. I will post quiz 1 again as soon as the administration of your program gives me the access to appropriate tools. Okay, so I hope to post it today, if not in the next couple of days. But you will have, it will be a timed assignment if it works. So likely 90 minutes. So what will happen? It will be posted. But as soon as you open the assignment, the clock starts ticking. So you have to submit it within 90 minutes. That's the way it works. Again, it's an individual assignment. You cannot do it in groups. Anna?
And this assignment will include all topics before this lecture or this lecture too? Something new?
Including this lecture, including the, mostly that's the cost of capital calculations. What we started last week and what we discussed today, that will be tested on the quiz.
Thank you.
So make sure to review the solutions to the case so you know the levering, unlevering. You can replicate the same thing. That will be the technical part of the quiz. All right? If you think I'm going to lecture more, are you mistaken? You can go. You can go home.
Nice weekend.
Have a nice weekend.
Thank you. Bye.
Thank you. Bye.
Bye. Bye. See you.
Thank you. Goodbye.
Bye. Have a nice day.
Goodbye.
Gregory, if I may to ask you about our case, because I've tried to correct the mistakes and I can't get to the correct beta for the petrochemicals. So maybe you could point me in some direction, because it seems to me I found.
I'll give you the solutions, so you will see.
Okay. So we will see like the formulas.
Yeah. I'm not going to give you the Excel file, but you should be able to replicate it.
Yeah, because I found this mistake. I didn't like freeze this this tax rate, and that is why I had some discrepancies in terms of these calculations. But nevertheless, everything is matching now except this 0.
The process is you do have your post-discussion summary. If you need to recalculate in Excel, submit the summary in Excel.
Yeah, okay. Yeah, maybe I will take a look at solutions, and maybe I will come up with some idea why it
That's
didn't.
that's the whole process. That's the way it works.
Yeah, okay, no problem. Thank you.
Okay.
Have a great evening. Bye.